Good morning, Dan Fitzpatrick here, and I'm just doing a quick chart of the day video. I just kind of wanted to show you a couple things. I finished a live trading session this morning, which we do every so often, and new members particularly like it because the idea is want you to make some money, and we were certainly able to do that this morning. And by the way, shameless plug. If you're not a member, free trial for 30 days, do it on me. This is the best time to join because the market's still really strong. It's very kind of complicated right now, but I can help you through it and help get you on the right track. Again, it's on me. So here's what we did, though. I'm going to look at TDOC and Palantir, and I'm going to talk about the two sides of risk. People typically think of risk as losing money, like, oh my gosh, I don't want to buy that stock because that's risky. Okay, what's your risk? You're saying like it's risky because I might lose money. Okay, but then you're not really thinking about the other side where I'm afraid that if I don't buy that stock, I'm going to miss out on a great trade. I'm not going to make money. So it's actually risky to not buy the stock. Now, that doesn't mean you go out and buy any stock. It means that you always have to be assessing the two sides of risk, the risk of losing money against the risk of not making money. And somewhere in between is the sweet spot. And to define that sweet spot a little closer, the idea is that you buy a stock at the point of, like, right at the point of most resistance if you're buying a breakout. When I say most resistance, I'll actually say like right when the stock breaks through the point of most resistance. Like on this particular stock here, you'll see this was the peak. Okay, that's the point of most resistance. That's where it's like, oh, crap. Every time when the stock gets up to 235, look at this. It got up to 235, a lot of selling pressure pushing that stock down. So, yeah, the stock fell, but it actually didn't fall that far. It fell down to 220 and then started moving higher. Okay, so now we have a point where the stock finds support, and we also have a point where the stock finds supply. Okay, right about, what did I say, 235. So after this little pullback, this thing gets up there again to 235 on the nose and then sells off. And so you say, all right, lesson learned. I'm not going to buy this stock until I know that it's going to push through 235. And that's a good thing because 2 days later, the stock's still down below. 3 days later, it's still down below. It's not until January 20th, which happens to be my birthday. Thank you. Happy birthday, me. When the stock broke out above 235, you're buying just above the point of greatest resistance, right at the point where there's been a lot of supply. And the reason why that's important is the only way, this is obvious, but typically you need to kind of understand it. The only way the stock's going to get above 235 is if all the stock that was for sale at 235, which is what capped this day and this day, is if all the stock for sale at 235 has been soaked up. And only then will the stock ultimately move higher. So this is the time to be buying TDOC right here. Okay, so we took this stock, actually we took it down here the last time the stock broke this line of greatest resistance, this supply line here. So we actually, we got in a little bit late, but it was an awesome trade. So we're buying the stock here. The stock's up yesterday, up at 30%. And I said, okay, it's time to book profits. And so we took profits. And this is why I'm talking about this trade. First of all, it was a great trade, and you can do this too. But the other thing is there's the two sides of risk here. So why did I choose to sell it yesterday? Do I think the stock's done going down? No. Do I think it's toppy? Actually, no. I mean, on a daily chart, yeah, but that's the point. It started looking to me like there was more risk of downside than there was of further upside. And so the balance, the scales of risk, balancing risk of missing out versus risk of loss, it skewed now. It started tipping down in favor of the risk of loss. And that is why I chose to sell this stock. Same thing with Palantir. We had a great trade. We got this trade on Friday and made about, if I recall correctly, about 30% on that as well. And the idea again was, look, this stock's looking, hey, new high, IPO strategy. This thing could go to 40, 45, 50 bucks. But as I looked at this here, I'm seeing more risk that the stock could fall, especially the way it traded yesterday. You know, it looked like it had the potential to fall. And so we got out of it. That was a good trade because, yes, we risked missing out on the upside, but we didn't want to risk getting caught and have a lot of our profits taken off. And so the idea was, you know what, 30% in like less than a full day of trading, that's good money. I'll go ahead and take that off the table. So now if Palantir keeps running up here, I'm not going to regret selling it because that was definitely the right trade to make. If Palantir falls down to 30, I'm not going to be happy that I sold it because I didn't sell it because I thought Palantir was going to fall down to 30. I sold it because I was concerned about the risk of a pullback. So I don't look at this as like if it does pull back, I don't look at this as, oh, I called that one. I got that one right. No, it has nothing to do with that. The stock's going to do what it's going to do. It has to do with the fact that I'm looking at the way my position is and saying, wow, this is a good position and I got to protect that. And so that's what I've done. Anyway, so I just wanted to go over these with you because I think it's important to study trades that worked out really well, particularly trades that you can explain why you did what you did, because once you can do that, you know, then you start having something that you can hang your hat on, and it can be an expensive hat, which is nice. I can't wear hats. My head's too big. Makes me look like a watermelon with a hat on it. But maybe you can. So anyway, just watch stuff like this. Don't be too eager to just get in on something after it's already gone up. That would be beyond meats. Nice move higher, and you could say, oh man, the stock's up 21%. That's awesome, but not if you bought at the open. If you bought at the open, the stock's down 12%. That's a big losing trade. So have your criteria, what you need to do to get in, what you need to do to get out, and it's always about the two sides of risk. That's hugely important, okay? All right, that's it. I'll see you next time.